The inflation has turned back down after 2 straight months of increases. The April increase in prices came at 3.4%. That's way down from 9.1% peak 2 years ago. But the rate still hasn't managed to return to 3%, which we hit last June, and it's still above the Fed's target of 2%. Several grocery prices went down from March to April, among them poultry, eggs, milk, and vegetables. Health insurance is also down 11.6% in the last year, but car insurance is up 22.6%. To help us understand these numbers is Jeanna Smialek. She's a New York Times reporter covering the Federal Reserve and the economy. Good to be with you again. Let's start with car insurance. Why are those numbers elevated?
Yes, we have seen this to be a consistent trend in the car insurance market. You really saw a big jump in car prices during the pandemic, and that also affected car parts. Car parts became very expensive. Replacement parts have remained very expensive. And so what we've seen is that these insurance claims are increasingly large. And in order to cover that, car insurers have been jacking up prices. So this is a trend that has been happening for a while. A lot of economists expect that it will last somewhat longer and then eventually peter out. But we are still waiting for that to sort of cross the Rubicon on that one.
So housing costs, they were up 5.5% since last year. And the Fed chair, Jerome Powell, said that this is, quote, a bit of a puzzle. What does that mean, a bit of a puzzle? What does he mean, and what's going on with housing?
So housing, it will surprise no one who's watching this to know, makes up a very big part of the consumer budget. And as a result, it makes up a very big part of the consumer price index inflation basket. It's about 33% of the whole basket, so a third of the whole basket. And for months now, economists have been expecting that measure of housing costs to come down because it is based almost entirely on rent prices because it's trying to capture the consumption cost of housing. And rent prices in the market, new leases have been steadily declining, or at least climbing at a much slower rate in most markets than they previously had been. And so that was expected to feed into this inflation measure over time. But what we're seeing is that it's not happening as quickly as expected. People are not renewing leases as quickly, or else when they are renewing those leases, they are not renewing them at the sort of much lower rates that economists were expecting. And so housing inflation has been a lot stickier for existing rents than people had anticipated. And that has just been a real surprise. And we're still waiting to see when it changes.
And what do you think the Fed will make of these new numbers as they make their judgments about rate decreases?
Yeah, so I think they've got to be breathing a sigh of relief because I think there was a real nervousness that this number was going to be worse than it was. What we saw was that inflation moved down a little bit. It was still sort of looking a little bit stickier around the edges, but it wasn't the kind of really bad inflation report that we've seen for the past 3 months. And so I don't think that this is the kind of thing that's going to change the Fed's mind. I don't think you're going to see the Fed reacting to this by cutting rates immediately, but I do think it's the kind of thing that probably makes them feel a little bit more comfortable with the, reality or expectation that the next move is going to be a rate cut and that it might come as early as this year.
You wrote recently in the Times, or co-wrote a piece in the Times about how high interest rates are hitting poorer Americans the hardest. We sometimes shorthand the talk about the economy in these broad strokes. Explain the disproportionate effect that interest rates have on that portion of our country.
Right. So high interest rates pretty much always hit poor people the hardest, but you can really see that this time around in a couple of places. One is that credit card rates, very, very high right now. And most people in America who have credit card debt, outstanding credit card debt, tend to be a little bit more cash strapped, tend to be from that sort of lower portion of the income spectrum. The other group of people who are really being affected by these high interest rates are folks who want to get into the housing market. If you don't already own a home, you're much more exposed to rent increases. You also, obviously are grappling with the reality that if you take out a mortgage, you're going to be paying these much higher interest rates. And so it's been a real effect in sort of the bottom half of the income distribution. While, and this is the thing that's unusual about this cycle, the real surprise here is the top half of the income distribution is not suffering the way that they usually do from high interest rates this time around. We've seen stock prices be pretty strong recently, and we've seen home prices really be resilient to these increases in interest rates. And so that means that people who own their houses, people who have big investment accounts, they're not doing so badly.
Jeanna Smialek, Federal Reserve and economy reporter for the New York Times. Thanks as always.
Thanks for having me.